Yo, what's going on, everyone? Welcome back to another video. Today's video is going to be on liquidity. I've talked about this many times in my other lessons, but today we're finally getting to the big topic everyone wants to learn about, which is liquidity. Now, as you guys know, as I went into the retail trader versus smart money trader video, I went deep into how liquidity is searched by the institutions targeting the retail traders, meaning that all the retail traders are getting stopped out, but us institutional traders, we're trying to get in while they're trying to get stopped out. So basically, I'm gonna do a quick little explanation on what liquidity is and how we can find it. So before we get into these examples, let's define liquidity. Liquidity, I know you guys have heard it in like the stock market or maybe in a business, like you're liquidating all your positions or something, but it's not like that. So liquidity in forex is generally just think about it as money, right? So we all know as retail traders, we're all retail traders at the end of the day, but we all know when we used to trade the retail way, there was a bunch of different types of ways we would trade, such as support and resistance. We had a bunch of forex patterns that we would trade, such as the double bottom, the double top, the flag patterns, and all that. Now, basically, those patterns are known patterns that every single trader at this point knows. Anyone knows. Someone who doesn't even trade forex, he could easily come to the charts, look at these patterns right over here. We'll get into this, but look at these patterns, or any of these patterns in general, and they're like, oh, okay, so I'll just buy the next time the market does a bullish flag pattern, right? So in general, liquidity is basically money, and basically mass amounts of money in really obvious areas, and the banks like to target that money. So I'll give you guys an example. So we have an area of support and resistance where the market is creating the support and we have this area of resistance. Now each time this level gets tested, retail traders are told that this level becomes stronger. We can see that this level got tested about 4 times. 1, 2, 3, 4, and then 1, 2, 3, 4, 5. So yeah, so basically retail traders, what they tell us is that the more times this level gets tested, the stronger it becomes. But in reality, what happens is the more times it get tested, the weaker it's becoming. So think of this as, sorry, oh shit. So think of this as 1 million positions got added on over here, and then 500,000 positions got added on, and then 100k, and then 20k. So as the more tests it gets, the less positions are being added on. That's how we should think. But instead, what we're taught to think is that the more times this level gets tested, the more positions retail traders are adding. So for example, if I was a retail trader, or if I was trading the retail way, I would be selling here, and then everyone else would also be selling here, because this is such an obvious level of resistance. We all know that we're supposed to sell at resistance, buy at support. If every single trader is buying at this same level, then that means every single trader is also putting their stop loss around the same area. So I hope you guys get what I'm saying. So over here we have this level of resistance, and it's been tested multiple times. Retail traders think that the more times it gets tested, the better it becomes, right? But as smart money traders, we're not looking to buy at support, sell at resistance. We're looking to buy when retail traders are getting stopped out, and sell when retail traders are getting stopped out. So for example, everyone sells here, they put their stop loss above. Now, as I said, money is considered as liquidity. Stop losses are money, right? Because if the market were to hit your stop loss, who makes money? It's not like the broker is the only one who profits off of you getting stopped out. The banks make that money. When you get stopped out, the banks are making money. That's what you have to understand. So I'm not saying that every single time you get stopped out, the banks make money. I'm saying at major obvious levels of major obvious levels of support and resistance, that's where the banks are generally making the most money, because that's where all retail traders are thinking the same way. If, for example, if you guys have a friend who doesn't trade stocks or forex or any crypto at all, and he randomly comes up to you and says, yo, buy this crypto, I'm hearing a lot of good news about it. If someone who doesn't even trade crypto is telling you to buy a crypto, then most likely that crypto he's talking about is already known and everyone else knows about it, right? So same concept with forex. If this is an obvious level of resistance that's been tested multiple times, and millions of people are selling over here, that means millions of dollars are being stacked above in stop losses. And to the banks, these stop losses are like magnets. They have to target the stop losses. So you'll see something like this happen. You get tested, and notice this: every time the market does get tested in that same level of resistance, the weaker that level is becoming. You get this, weaker pushes. But right here, after that fourth push, we have that major expansion up. Sorry. So this time, the market breaks above the resistance. And when it did break above the resistance, what happened? Every single person who sold over here, over here, over here, or over here, and maybe even over here, if they did see some rejection, they just got stopped out. That's called a liquidity grab. That's called market grabbing stop losses. So how do we know that this is a liquidity grab? Well, one, we know that there's money resting above. So let me delete all this stuff right here. We know that there's stop losses resting above, right? It's pretty obvious there's stop losses resting above. Move this here, move this here. Alright, bro, let me just make this black really quick and then we'll do it. Alright, so we know that there's a stop loss resting above over here. Until the market breaks and closes above this level of resistance to make it not valid anymore. Remember, the market has to make it not valid anymore for the retail traders. Because remember what retail traders say, when you get a breakout of a resistance, it's no longer valid and you're supposed to see it as a break and retest, which we'll get into that. So we see there's money and then boom, the candles close above the area of resistance to grab all that money, and right after you see that money, the market reverses down. Why does it reverse down? Why does it end up going down? Well, this is because, like I said, the banks are trying to get in when the retail traders are not in the market. So if the banks know that the retail traders are here and they're right about selling, but they're just not about the timing of when to sell. So if the banks do want to sell, that's their ulterior motive, then obviously they're not going to be selling and allowing all these retail traders to get in with them. What they're going to do is they're going to make price go up so they get all stopped out, and then price goes their way. And then obviously the market is attracted to liquidity. The market moves off of where the most liquidity is. So if we took the money of the highs and we have an overall bearish structure or analysis, then we know that the next area the market is going to go to is the next level of liquidity, which would be the lows over here. Because as we did stop out all these sellers, we still have the buyers to stop out. Right? Now there's people buying over here. We have a test here, one more, 2 or 3, 4, 5. We have 5 tests of support. Market's going to have to tank down to take out all that money. So the market generally just moves off of liquidity to liquidity. Now, this is the same exact concept, but in a bullish example, what you'll see is the market will take out the money of the buyers first. So everyone who's buying over here, they do get stopped out. And then price reverses to take out the liquidity of the sellers. So think of it as a magnet. If we took out the money here first, where's the money going to get taken out next? Obviously, we have equal highs resting above over here. So that means that the market is going to have to use this level as a magnet, and it's going to have to make a rally above it. And that's what ends up happening. Now we also have pattern type of liquidity, which I was going to get into right now. So let me just get a quick drink of water. Alright, so we can see that we have the head and shoulders, the rectangle, the channels, the flag, the symmetrical triangles, the ascending triangle, the double bottom, the double top. We have all these retail trader tools, and we have all these retail trader patterns. Now, not only that, but one more thing is that a bunch of people take the fib, let me make this to my applied default, and they're buying at the 60 and 50. For some reason, I don't know who created this idea that the 1560 is the golden level. It's not discounted at all, or it's not even premium. 50 and 60 you shouldn't be buying here, and this is another type of liquidity we'll get into later on. But this liquidity right over here is called flag pattern liquidity, dynamic support and dynamic resistance. It's basically support that's moving up and resistance that's moving up. And what we're told is, we're told to buy every time this level gets touched. Every time this level gets touched, buy. Sell every time this level gets touched. Sell every time it gets touched, sell every time it gets touched. That's what we're supposed to, to do. That's what we're told to do. And what that does is that creates a bunch of liquidity for the long term to get picked up. And I'll show you guys a couple of examples of all of this. So now there's money resting below and there's money resting above of the sellers that are selling this dynamic resistance. So we know that eventually the market's going to have to tank down to take out the money of the lows and the highs. But what are we told after we do see a breakout of this channel, right? We're told to buy the breakout. The retail traders or the teachers such as Nick Sean, I'm not dissing anyone, or I'm not, you know, calling anyone out. I'm just stating facts. Nick Sean, all these other, you know, retail traders that trade this way, they basically tell you to buy at the breakout of this channel. So that means you're buying the breakout, assuming that price is going to continue going up with your stop loss below. Now, everyone, remember, every single person knows that you're supposed to buy the breakout. If everyone is buying the breakout, then most likely the breakout is not going to continue going up forever. There is a chance that it'll give you a decent, you know, a couple 100 pip move, or maybe a couple 50, 60 pip moves. But most likely what the market will end up doing is it will, let me get my tool. It will reverse down to take out the money, because what it's really doing is it's taking money of the sellers, because everyone who sold here, over here, and over here, they're all getting stopped out now. And then the market's going to reverse to take out the money of the buyers, the people who bought from here, here, and here. And this type of liquidity is different from this type of liquidity. When we do see bull flag liquidity or pattern liquidity, the market will generally make a big, deep move down, aka taking the money above, and then it'll make a big, deep retracement down to take all that money below. Because yes, they'll be stopping the people over here, but the people who bought over here, they're gonna have their stop losses way deeper, and price has to make a deep retracement in order to take out that money. So that's bull flag liquidity. We also have the double bottom, you know, when the market comes once, twice, and then the market goes up. We're told to, you know, this is a double bottom, it's really powerful. You're supposed to buy here, and the next time price comes here, buy again. Once you see that type of double bottom forming, you can already draw your line and, you know, say that there's liquidity resting below. So this is how I draw my liquidity. I get a line from the first touch to the second touch, and I draw an X, right? You can do whatever you want. You can also use the equal lows thing, doesn't matter. But basically what this identifies is that there's money below over here, meaning that price, the next time price does come towards that level, or towards that double bottom area, it's not going to react off of it once again. Maybe it will, but most likely it won't. What it's going to do is it's going to make a rally below to take out all that money, right? And that's what we're not, you know, told to do for some reason. Now then we have the break and retest and the breakout. So right here we have this level of resistance, right? The market created this level of resistance once, twice, 3 times. It's been tested multiple times. It's really clean. So I'm just making sure I'm not recording. So we have this level of resistance. It's been really clean. 1, 2, 3. Now from a retail trader perspective, it makes sense to sell, right? It makes sense to sell over here. And the more times it gets tested, the more times you should sell. So we know as institutional traders, there's money resting above. So what that means is that price is gonna have to break out above. Now we see that breakout. To us, we know that this isn't telling us to buy. This isn't saying, okay, buy the breakout, and you know, it's not telling us to do that. What it's really telling us is that the market is just taking liquidity now. Excuse me. So the market is taking liquidity now of the sellers, and then, but to the retail traders, they're seeing this as a breakout, and they're saying, okay, bet, I'm gonna put my buy stops right over here, and all these buy stops are being triggered. Buy stops and sell stops are basically, so we all know what sell limit and buy limit is, but a buy stop is basically when you're setting a buy stop above your area of interest, where if price breaks above your area of interest, it automatically triggers you in. So for example, let's say I'm thinking about buying like right, or let's say I'm selling right over here, right? I'm thinking about selling this resistance. It gets tested multiple times. Boom, and then I set a buy stop above right over here. So if the market does ever break out, it automatically fills my entry in right over here, and then it continues going up. That's what a buy stop is. And now this is where retail traders are setting buy stops. So they're setting buy stops above this area after the breakout, so they get triggered in right away. And this is considered as your break and retest. So we have the buy stop traders who are entering on the breakout, and then we have the break and retest trader waiting for that test of resistance to turn into support. Now in this case, what would end up happening is price would most likely, you know, react off of it a little bit, give you, you know, that excitement that, okay, price is going my way, I don't need to worry, might react a little bit, but then eventually the market will tank down, and then it will either take out the money of the lows, which would be right over here, equal lows, or what it would do is it would just go lower to test a institutional candle, and then from there it would continue going higher. Now as you can see, at this point sellers got stopped out with this move up, At this point, buyers got stopped out by breaking retest and breakout traders, right? Because the buyers who were buying right over here, they set their money and liquidity way below here. So that means price broke below to stop out all those traders. So now buyers and sellers are both out of the market. If buyers and sellers are both out of the market, what does that tell you? Because it tells you something. There's a story behind it. What this tells you is that the psychology of the retail trader, of the support and resistance traders, they're confused. They're scared to buy and sell now because selling didn't work and buying didn't work. So that's when they're most vulnerable. That's when the banks are getting in for opportunities to buy and sell. So like I said, the banks are getting in when retail traders are getting stopped out, and I hope that makes sense. Now let's go to some real live examples before I keep showing you theoretical examples. So we're on Euro USD right now. This is a pretty volatile pair, right? And I'll try to find some liquidity examples, and I just found them right here. So right over here, what do we see? Now remember, it's not going to look this clean like I showed you guys in the example. It's never going to look like this. Sometimes it will not look like this. It'll be really messy, but you just have to get the overall idea of how the retail trader is thinking. So right over here, this is what we're seeing happening. The retail traders are thinking about selling at this level of resistance right here, and this means there's liquidity above equal highs. We have a test of support. Sorry, we have as we can see right here, we have a test of resistance right here, another test of resistance, another test, and then yeah. So we have 3 tests of resistance, and this is basically telling you to sell, right? But we know as smart money traders, there's money resting above here, and eventually the market will have to come take out all those lows, right? Now let's look at this. Now not even that, but on the higher time frame picture, like the 4 hour, we also have right over here, we have even more liquidity resting here. We have this level of support, equal lows. Now from a line, if I draw a line, it's not that clean, but look at this. If I draw a zone, it's even. It's so clean. Look at this. Resistance, support. That's clean. Anyone can see that. Okay, yeah, this is a level of resistance and support. Retail traders are selling it. Now what happens? That means that every time the market does come to this level and test it, there's money and stop losses being rested above. So right here, we see that the retail traders are selling, right? And look at this. So let me go to replay mode right here, and boom. When we see the candlestick come to our zone of resistance, and it shows us that wick rejection, this induces and it influences a lot of people to sell, because remember, the retail trader's mindset is candlesticks, candlestick patterns. This is like a doji, some hammer stick type of candle. I don't even know, right? But this is some hammer stick type of candle, which is a confirmation for a reversal. And at this point, millions of people are looking to sell now because they see that rejection and they're putting their stop loss above, and then TP most likely at the next low of the support. Now let's see what ends up happening. You get stopped out, and surprisingly, after the price breaks above your area of interest and takes out all that money, it randomly reverses. This isn't random. This isn't a coincidence. This is literally how the banks are trading. And I want you guys to notice something. Look at the momentum in these candles. The momentum in these candles, what I mean by that is they're big. There's a lot of volatility in these candles. If we check the volume indicator, I don't use volume, but I'm sure there's something interesting here, right? Vol. Yeah, I don't know why the volume indicator is not working, but basically there's a lot of volume inside of this area right over here. There's so much momentum, it's so engulfed that you can just see that the banks are getting involved in this area right here, and then randomly it reverses. But where is it going to reverse? Is it going down to the middle here and then going up? No, it's going to be going down to the next level of liquidity, because that's where price is attracted to. And let's see what ends up happening. So price does its thing, consolidates for a bit. My bad, let's delete this. And wow, now look at this. We created more liquidity. So price now created another level of support. We have the test right here, a test right here, a test right here, and a test right here. What does that mean? Well, that means that there's more liquidity for the market to grab. There's more buy side liquidity below that the market has to take out. So the market has to take out the lows over here, and it has to take out the lows over here. So when you're staring at a chart and you're thinking about, okay, wait, like, where do I sell, where do I buy, where's price gonna go, just map out your liquidity. look for where the most liquidity is, and most likely price is going to go down towards that level. Now obviously it's not that easy. We're going to get into how to actually properly analyze later on in the course, but for now we're just going to stick to liquidity. So let's see what the market does. And right here, price breaks out, right? It breaks out to the bottom and takes out all the stops below. Now once it took out all the stops below, it also made a run below these stops over here, because there's money here and there's money over here. Now if you play what ends up happening after, look at how quickly after price did take out all that money, look how quickly from there it completely just continued with its bullish momentum. And then let's play what ends up happening after this. And you can see by the momentum and the bullish candles that how quickly price moved away. As soon as it went below like 90 pips to take out all those stops, look how quickly price moved up. Moved about like 220 pips. Now we also have another type of liquidity, which is our bull, our bull flag pattern, whatever you want to call it. We can see that we're told to buy every time price touches zero, and sell every time price comes towards this level. Now these are obvious levels that retail traders are thinking about selling and buying at, and at this point there's just money resting all over the market now. Now we've seen that price broke below, right? And it's clearly taking money of this bull flag pattern. What you also have to remember are the breakout traders are taking sell positions right away. There's sell stops resting below. So now these sell stops are getting triggered. They're probably going to target the next low wherever it is. And then let's see what ends up happening. The market randomly, randomly just decides to reverse and continues going up. And what happened when it continued going up? Well, it didn't take out the money yet, but we did break out of this flag pattern, stopping out all those buyers that were buying at that dynamic support. So, and you can see generally how quickly price moved down after it did stop out all those people. So that's generally how liquidity is works on the market. I'll definitely show you guys a lot more examples. Let's go to CAD CHF, right? Boom. Let me actually go to my profile, and I'll show you guys a trade I called out. Okay, CAD CHF. So we can see that there's this level of resistance, support right here, and then level of resistance right here. Right, I have to zoom in for that. So we have this level of support and this level of resistance. Now we know that there's money resting below. So while all the retail traders are thinking about buying here, buying over here, and buying over here, all their money is resting below. And then we know that long term, we know price is going to go up because there's money resting above over here, and it needs to take out that money. So what I did is I looked towards my left and I found my untested levels, which were, there's an institutional candle here and over here, right? And or this one and this one. So let's play this out, see what ends up happening. And you can see perfectly it did not stop me out. It missed me by like 0.3 pips, but perfectly price comes down to take out the liquidity, stops everyone out. Now notice this. While all these buyers were getting stopped out, I was getting in at the level they were getting stopped out. Notice that. So this is where institutional traders are getting in, and this is where retail traders are getting in. And this move down is stopping out all those retail traders, while institutions are waiting patiently. My first entry right over here, it's untested. There's a lot of momentum in this, and no retail trader is thinking about buying here because they don't see that it's tested. They need to see tested levels in order to buy. In our theology, we don't need to see that. Price comes down into our untested level, completely shoots up, and then it came down to our second untested level, which was this, to test it, and then from there it shot up, and obviously it ran up towards the next area of liquidity, which was right over here. All these stops that rested above, and price came perfectly there and ended up reversing. Now let me show you guys a XAU USD analysis. XAU USD, and boom. Let's delete all this. Let's go to the 4 hour. Now on the 4 hour time frame, what are we seeing? What are we seeing over here? Right, this is the sell that I caught. I caught this big major sell from this point of interest right here. I did make a video on this, so if you guys didn't see that, like, make sure you watch it. But yeah, so we can see in this area there's a lot of momentum, right? Now we're not going to get into momentum and institutional trading or anything. We're just going to stick to liquidity. Let's stick to what liquidity is telling us. Now, from a retail perspective, right? Let me make this a different color. Let's make this black. From a retail perspective, there's a ton of liquidity resting over here. There's a test of resistance, another test of resistance, another test of resistance. Now we know that eventually the market will have to break above this resistance in order to take out all that liquidity. Now what we also see is that on the 1 hour time frame, we have more liquidity resting over here. We have a test of support, multiple tests of support, and then even more resting over here. We have more money and liquidity resting over here. We have a test of support, another test, another test. So let's move this over here. Now let's see if there's more tests of liquidity towards the bottom. Now at this point we even have some liquidity over here that the market needs to come. There's basically money resting everywhere in the market because there's these obvious levels of support and resistance. We have a test over here, that means there's stop losses. Over here, stop losses. Over here, stop losses, right? So we know that eventually gold is going to have to sell off to the downside to take out all that money. But we don't know when, and my job is to teach you guys when that's going to happen. We'll get into that in a different video, but for now I just want you guys to see that there's money resting here. So let's use my tool to jot down where the money is. Liquidity, right? And then right over here we have more money over here, liquidity, and then once and for all we have money over here, liquidity. Now if you guys have a really good eye, I want you to pause this and I want you to find the dynamic support and resistance liquidity. Now I'm gonna delete this, I'm gonna delete this, I'm gonna delete this. Pause the video and try to find out where the dynamic support is. Now if you guys paused it and you found it, good job, but it's right over here. Look at that. What is this? This is a bearish pennant, I think. I'm not too sure. Like, let's see. Yeah, so this is a bearish pennant pattern, or a bullish falling wedge, whatever you want to call it. At this theology, what they're saying is that price is going to test this support, and as it gets weaker and weaker, or smaller and smaller, it's going to burst out towards the upside. Now that does mean that there's stop losses of everyone who's selling over here. There's stop losses above, and then there's also buy stop losses of all these traders that are buying over here. So initially what that means is price created liquidity all around this move up. There's a bunch of money resting all around this move up, specifically because there's buyers buying over here, over here, over here, just trying to catch this big move up. Now look at what price does. Let's pause this now. So price makes a rally above the area of liquidity right over here. We had money resting above of this test right here, this test, and then this test. Price breaks above it to take out all those stop losses, goes to our untested level where there's a lot of momentum that broke structure, and we have an institutional candle there. And then look at where price goes next. Like I said, price goes to wherever the most liquidity is and untested levels. We know that there's a ton of stop losses resting below this area right here. That means that gold is gonna have to drop all the way down to take all that money. And look at what gold ends up doing. Let's just play this out quick time. But yeah, you can see how quickly and how motivated it was to really fall down. You can see the momentum in the candles that banks were actually getting in here. Now this is the difference between institutional trading and retail trading. We're not buying off of a resistance or support touch or some black line touch. We're buying off of proper real confirmation by following the footprints of the banks. Over here we know that there's a test of there's an institutional candle, which gives us identity and identification that the banks were getting in sell positions over here, and price is gonna have to come back and test it. For retail traders, they're not seeing this as a level to sell at, and that's what differentiates us from retail and institutional. We're getting in while all these retailers are getting stopped out, and we're actually getting in with proper confirmation. I'll show you guys some more examples. Let's go to GBP USD. Let's go to a new chart on GBP USD right here. Boom, delete everything. So right here, perfect example. We have this level of resistance over here getting tested multiple times. Liquidity top. So we have this level of resistance over here getting tested multiple times. We have a test over here, another test over here, a test over here, and a test over here. That means that there's money resting above that the banks are gonna have to go and take. Now not only that, but okay, this is already hindsight, you guys have seen this, but over here what we can see is that there's liquidity resting below. So liquidity bottom, my bad. So now we know that there's liquidity resting below. The market is gonna have to come down to break out below to take out all those stops of these retail traders. But let's actually see what the retail traders are seeing and what they're doing. So right over here, we have a buy position, right? People are buying. A bunch of people bought. Second time, people bought. Some people may have gotten stopped out if their stop loss was small, but overall, the market still went up. Third touch over here, because it is a zone, it's not a line. So third touch, people buy. Fourth touch, more people buy. You see how bad this looks now? Every single trader is buying over here. Now notice this: the first time the market came over here, it had a really decent push up, right? Let's see this. It had a decent push up for about 113 pips. The second time it was smaller, about 86 pips. The third time the market went a little bit below to take out some stops, not all but some, and did give us a really nice push, about 132 pips. But then notice how the more times it got tested, the weaker it got. From here it only gave 70 pips, and then 58 pips, and then from here about 42 pips. So each time it gets tested, the weaker it's getting. And I haven't even gone into the sellers that are selling over here. We have sellers selling here, and over here. There's a bunch of money all over the market. Now imagine you're a bank, right? Imagine you're a bank, and your goal, you work at a bank, and your manager says, your hedge fund manager says, your goal is to get in when retail traders are stopped out. Get in when both buyers and sellers are both stopped out. So your objective is to bring price higher, because obviously the market maker has an objective. They don't just buy and sell because they want to buy and sell. They have objectives of where they want to take price and why they want to take price specifically there. So obviously we can see that the trend is up. Just let alone understanding the trend, we know that obviously the market makers are buying right now. Long term, they're definitely buying. So that's why they let the sellers sell over here. Because if they stopped out the sellers first and then stopped out the buyers, it wouldn't make sense. What makes more sense is they're going to stop out the buyers first, and with all that money that they took from the buyers, they're going to use that money to buy more positions, add on to their buy positions, and then from there bring price higher, take out the liquidity, and do the same thing again. For example, it'll look like something like this: consolidate, take out money, and then do it again. It's basically a reoccurring pattern. Consolidate, take out the money, do it again. That's literally the pattern that the market is following on GU. So let's play out what ends up happening. And look at this. This is not a coincidence. Let me draw my horizontal line. Boom. Price comes into this area right here, and what does it do? It breaks below our area of support. Stops this person out, this person, this person, this person. Now millions of money just got taken out. 100%. Millions of dollars. Now what you also have to notice is that there's sellers now. Remember the sell stop traders. The people who sold, they put their money above over here as well. So when the market did end up breaking down, they got stopped out as well because there's money resting above. Now we took out the money of the buyers. What's left? Obviously liquidity of the sellers. So let's play this out and let's see what the market does. You can see it makes a rally above the area of where the sellers were selling. The stop losses all got taken out. Every single seller who sold over here got taken out. And now we can notice this and differentiate from this as a liquidity grab. This was simply a liquidity grab. How do I know this? Well, because the market broke down and reversed right away. And really look at this. Look at this big candle over here. Banks were clearly getting involved in this position right here. And let's see if the market has done this before. Right over here, same exact thing. The market created this level of resistance and support. Money resting above, and then money resting below. Liquidity cleared. So we have equal lows resting here. All these support traders are buying. Remember, it doesn't have to be literally equal. For example, if you're trying to make equal lows and you're worried about over here the wick went below, whatever, don't worry about that. It's just a zone. Remember, it's basically a zone. We're just using a line to make our charts look nicer. But if you were to draw a zone, it would look like this, right? So it doesn't matter. As long as price breaks below that zone significantly, we're good. So we have equal lows, equal highs. Obviously the market is going to take out the lows first and then take out the highs. And look what ends up happening. The market takes out the lows. Takes out the lows, what ends up happening after? And look how perfectly it did that. The market took out the money right here, gave us that proper liquidity grab, and then from there it made a rally above, doing what? Breaking out right over here with this candle wick right here and candlestick. this moved about 18 pips and stopped out all these sellers over here and over here. So boom, liquidity got grabbed. Now look, like I said before, after the market takes liquidity of the lows and highs, it'll do the same exact thing. And this is where the market created that level of resistance that we just went over. And let's play this out real quick. I'm not trying to play this out forever, but yeah, so right here I think it was, we had that liquidity grab. And then boom, we take out money of the buyers, and then we took out the money of the sellers. Now let's see if the market has ever done this before. Once again on GU, what do we have here? We have a level of resistance, right? Well, let me make a zone because this one's a little, so we'll get into this one right over here, and then I'll explain this, don't worry. So we have this level of resistance, and then we have this level of support. Now if we go down to the 15-minute, you can see that this level of resistance was already tested multiple times. If you draw it like this, right, it was tested multiple times. So the market did do a liquidity grab, stopping out all the people that sold over here, right? Now after you did get all those liquidity, all that stop losses got taken out, the market still used this level of resistance to manipulate even further. So even though we did do a liquidity grab earlier, the market still went back towards this level, and retail traders still use this level as a level of resistance. And what does that mean? Well, that means that there's money resting above that level. Now from a 4-hour perspective over here, what do we have? Well, we have this level of support, liquidity resting below. Now look what ends up happening. The market takes liquidity of the lows, and then it pushes up. Retail traders get stopped out, and then the market goes up. Sellers get stopped out, and then the market goes up. And this is a reoccurring thing that's been happening on the market every single day. This happens on the 15-minute, the 5-minute, the 20-minute, the 30-minute, 1 second, every single time frame you can imagine. The market does the same exact thing to stop out the buyers and the sellers, and then it goes up. Now for the people that are a little bit, or I'm sure a lot of people this makes sense now, but for the people that are worried about how you can actually identify liquidity on your chart, I'm going to do a random pair I don't trade, USD MXN. Random pair I don't trade. I'm not going to analyze it. Okay, I did trade it once, but like this was a long time ago. But all I'm going to do is I'm just going to identify wherever liquidity is. I'm just going to identify liquidity, and that's it. So let's look at where price is at right now. Currently we can see that there's money resting below here. We have this level of support. The market left this level, got tested once, twice, 3 times, 4 times, 5 times, 6 times already. That means there's a bunch of stop losses resting below over here. Now we also had stop losses over here of the resistance traders, but guess what? The market ended up breaking above it, right, to stop out all those resistance traders. All that's left is for the market to come back down to take out all the money of those buyers that who are buying right over here, over here, over here, and over here. And then the market is most likely going to continue up. So I know that the magnet is down over here. So the price is like a magnet. It's going to have to go down over here, and then from there it's going to go up. So that was basically a good video on liquidity. I hope this video made a lot of sense. Take notes. Yeah, rewatch if you guys have any questions, and I'll see you guys in the next one. Peace.